Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, June the 23rd. I'm Eric Wilkinson, and yes, you very well may recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, how that impacts the overall markets with my market analysis. Well, I do the same thing in these daily market commentaries, you guys, but on top of that, I talk about option strategies that I implement into my portfolio according to some guidelines that I teach in my webinars. So check those webinars out at protraderstrategies.com. And without further ado, let's get on with that economic data because today is a pretty busy week. And today in particular, because we get some of the most important economic data points out of Europe, and that is in the form of flash PMI. Now, PMI is Purchasing Managers Index. Now, these are the managers that are forward looking. They see us as consumers coming to them, and then they start projecting forward what that demand is going to be. So they need to start getting some inputs going. This is why it's important. It's forward looking. A lot of the economic data points we get are hindsight. All right, so across the pond, French Flash Services PMI coming in at 50. Remember, anything above 50 is expansion in the economy. So that means it is looking much better. They're seeing this lockdown maybe and coming out of it, that there is a lot of demand, pent-up demand. It was expected to be 44.9, so nice number there. The manufacturing out of France, remember France and Germany are the main drivers of the manufacturing sector, so key points to look at there. French manufacturing coming in at 52.1, expected to be 46.1. German manufacturing coming in at 44.6, expected to be 41.5. Yes, it is below 50, but all of these numbers are beating the estimates across the pond. Flash services for Germany coming in at 45.8, expected to be 41.7. Did revise last month's number up a little bit. The rest of the European region, flash manufacturing coming in at 46.9, expected to be 43.8, and services coming in at 47.3, expected to be 40.5. Great Britain's manufacturing PMI coming in at 50, expected to be 45.2, and the services PMI for Great Britain coming in at 47, expected to be 39. So nice beats on those. Yes, some of them are still below 50, but nobody was expecting really above 50s anywhere, even on the estimates. Nobody even close to going above 50, and we saw a few of those, especially in France, going above 50, so that is a good thing. Here in the United States, we got our own flash manufacturing PMI coming in at 49.6. That one was expected to be 50, so a little bit lower than that expectation. But the thing to keep in mind, we look at the ISM for the Institute of Supply Management as the real economic driver there. Richmond Manufacturing Index coming in at unchanged, expected to be a -3, so that's good. Also, new home sales coming in a lot better than expected, up 676,000, expected to be 637,000. A lot of people are saying, remember we talked about a week or so ago that we weren't seeing a lot of permits being pulled. I think we're going to see that change. There is very little supply. I was talking to a couple of realtors over the weekend, and they were talking about the lack of supply for most houses. So that means a lot of people are out there now starting to build. They're seeing a lot of these builders get busy. So those new homes are starting to ramp up, and that's because there's a lack of supply on the market of existing homes. And that's pretty much it for the economic data points. Let's get on to the overall markets. Crude oil trading 41. Remember we talked about the 41.05? Well, this gap has been covered. So that is a mandate usually for markets. Now, I'm not expecting us to get up into the 50s, but we are starting to see some of these manufacturing numbers, especially across the pond, start to ramp up. Well, that means that we're starting to get those cogs turning again. We're also seeing high demand for cars, whether it's used or new. So that going into the manufacturing process of these cars, there is a lot of crude oil that's going to be going into those products. Because remember, crude oil isn't just the oil, it's the distillates from there. And we make polypropylene, which comes or creates plastics for the cars. We're also talking about the oils and everything else that produce the paints and everything else. All right, so crude oil goes into a lot of different things. It's not just going into the pump where we get our gasoline. All right, so that is starting to push a little bit higher. You know, I'd like to see it stay in the 30s for a little bit, but that market is in and of itself. So we could start to see that now that it's covered that gap, roll back over, at least for the short term is kind of what I'm looking for in there. I haven't put it on any trades in and around crude oil. I'm just keeping an eye on it. Gold though, remember I do have my long gold call spread on. I'm trying to get out of it. It is the GLD. I'll talk about that here in a moment. But it's come up there and tested right there at that area that I was talking about at 1787. You can see here we are just slightly shy of that 87, but I was looking for it to hit the 88 high. This is still would be considered tweezer tops if we started pulling back from that. But I do kind of think that we're going to test that a little bit more seriously before we start pulling back here. But I'm kind of talking my position there too. I am trying to get out of my GLD trade today, and I'm about, looks like about a quarter away. All right, so bonds coming off 21 ticks here, and you know, it's falling on that support of this 61 Fibonacci there, and that lines up with 176.20, which is right where we're trading right now. Staying above that 9-day would be a pretty big coup for us. I do think that bonds should be going back up towards that 180 handle as we are going to see interest rates remain constant for quite some time. So I'm not really expecting any big moves there. VIX is coming off. We did have a wild ride in the markets last night. Fox News had interviewed Peter Navarro, and she asked, you know, how is this U.S.-China deal going? And he basically said it's off the table or something like that. I can't remember his exact quote, but literally the markets just snapped down, and then he released, well, he meant something else, and it could have been misleading the way he said it, but basically it caused the markets to free fall, and then we've snapped back since then. We can take a look at the NASDAQ. Pretty big range, and you can see where the snap down was right here. It'll show up a little bit better. As a matter of fact, let's just pull it up on the breakdown to the daily chart here. We can see immediately where that Fox News interview with Peter Navarro was, and then the recant of his statement right afterwards, causing us to kind of snap right back, and then bullishness thereafter towards those highs. Something of note with that NASDAQ, United Airlines got pulled and DocuSign got stuck into the NASDAQ. I'm not really sure why UAL was in the NASDAQ to begin with, but interesting to note that they are putting DocuSign in there, which is obviously doing real well. That's one of those ones I haven't really talked about because I don't trade DocuSign. They don't have very good option markets. But DocuSign, obviously another company that you could put in your long-term, could have put in your long-term portfolio ahead of all of this when we were talking about ad stocks that are going to help with the home office where people are going to be using a lot of it. And that was one that probably could have been added to a long-term portfolio as well because it's making all-time highs. Anyway, E-mini S&P is up 27 points here on the day, again showing up Peter Navarro's interview and basically saying the China deal is off the table or something like that, and then the recant and the snapback. So other than that, I don't have anything that I've added. I am trying to get out of my GLD. One thing LYFT did do is go down there and touch my long puts where we were playing that directional assumption on the 35 puts there. Just hasn't really gotten to 50% increase of my trade there. It's pretty close, but it's not quite exactly where I want it to be. So I'm working in order in there as well to get out. Right now it's trading at around $4.35 for those 35 puts that I bought in the August. I bought them for $3.50. So, you know, a 50% increase would put me at closer to $5. So it's a little bit away right now at this point. But gold futures, again, you can see I did this gold trade where I did the August, bought the 160 calls, sold the 165, paid $2.10 for it. I'm trying to get out right now for $3.10. It's trading $2.92 and a half. So right now, not quite there, but we can see we are on the highs of the day there. I do think that gold's going to continue to move a little bit higher because they are talking about another round of stimulus for the coronavirus, as we're starting to see some shops actually start to close back down due to all the resurgence of these cases. All right, that's all I've got for you guys. I am trying to get out of this trade. And Thursday, we're going to be doing another webinar on long put spreads, you guys, and why we would set it up that way. Go through some guidelines, some specific steps as to when and where we'll set that up for a bearish assumption. All right, so check that out. Also, please take a moment to go over our disclaimer. As we are an educational company, I'm not here to solicit you on buying or selling any types of securities or strategies. Okay, it's up to you guys to be big boys and girls and find out if this is appropriate for your risk parameters. Okay, if you can't take that, take it easy.